that is by no means assured. In too many places, uncertainty is holding back both demand and the willingness to lend. A legacy of high public and private debt is hurting economic prospects, and the global financial system remains fragile. Now, in an interconnected world like ours, these forces are feeding each other across borders. Capital flows to emerging markets have already dropped off, and growth, as I said, is expected to be lower, even in the most vibrant part of the world economy. Low-income countries in particular are especially vulnerable. But before we indulge in yet another bout of collective pessimism, which is becoming something of a global sport, frankly, let me just ask a simple question. Why did 2011 turn out so badly? Because I think that if we answer that question properly, maybe we'll find the path for a better 2012. I would argue that it was not because of a fresh wound to the global economy. No, it was driven instead by a lack of collective determination to reach a cooperative solution. We saw many fails or half starts in 2011. In Europe, of course, you have in mind many summits that were due to find the ultimate solution and did not find it. But not only in Europe. For instance, in the United States, the debate about the debt ceiling was one of those as well. Put simply, policymakers let an old wound fester, and in doing so made the situation actually worse. Now, looking at it from this perspective, 2012 should be a year of healing. But as Hippocrates put it long ago, healing is a matter of time, and it is also a matter of opportunities. And today, it has to be an opportunity of our own making. Otherwise, we could easily slide into what we call a 1930s moment. A moment where trust and cooperation break down and countries turn inward. A moment ultimately leading to a downward spiral that could very much engulf the entire world. However, I remain hopeful, and I remain very hopeful. I believe that we can avoid such a scenario. I say this for a simple reason, because we know what must be done. And this is really my core message to you today. Although the economic outlook remains deeply worrisome, there is a way out. Now, the world must find the political will, the collective will, to do what it knows has to be done. All of it, and all of it by all. Now, I would like to structure my remarks to you this morning around three essential chapters, so to speak. One is I would like to focus first on the Eurozone and the path for the Eurozone. And I'm saying so because clearly the epicenter of the current crisis is the Eurozone. Second, I would like to address the role that other countries in the world can play in resolving the crisis. And third, I'd like to focus on the role that the IMF can play in that regard. Let's start with the Eurozone and the path for the Eurozone. And before I go into what remains to be done, I'd like to first of all acknowledge what has been done. The Eurozone did things that only 2 years ago would have sounded like heresy, unheard of. Let me give you a few examples. The Eurozone countries have established a cross-border safety net in the shape of the EFSF. More so, though, They gave it a much steadier and more permanent life by actually working out the ESM, the European Stability Mechanism. As I said, 2 years ago, only 2 years ago, and I participated in those debates, that would have sounded like heresy. Second example, they have taken a harmonized approach to bank recapitalization and set up a systemic risk board at the euro area level. Third example, they have decided upon governance reforms to enforce stronger and more effective fiscal discipline. Negotiations are in train, and that better be completed properly and with determination so that there is implementation of that fiscal compact and those governance rules that the euro leaders have promised each other. In addition, individual countries are taking serious measures to restore their credibility and to improve their fiscal situation. Fifth example, the European Central Bank, without relinquishing any independence, of course, has unleashed impressive resources to make long-term liquidity available for banks. Now, these are major steps that must be recognized if they are properly communicated. But I would not be the first one to argue that those are pieces, and only pieces, of a comprehensive solution. And many within Europe are themselves making this point with increasing forcefulness. So let me, having acknowledged what has been done, let me just offer my perspective on what remains to be done. And in my view, there are three imperatives. One is stronger growth. Two is larger firewalls. Three, deeper integration. Difficult, but they have to come together to support the enormous work that has already been done so that there is effectively a comprehensive solution. Let me turn to, first of all, stronger growth. It has a number of dimensions. First of all, let us just observe that with the euro area economy slowing down, inflation is already declining. And we see a sizable risk that it will fall well below target next year. Now one might think, well, that's not a risk, it's a chance. It is a risk. It's a risk because as a result, the debt will simply be heavier and it will further hurt growth. But there is an opportunity about it, that it allows central bankers to actually conduct monetary policy in a more determined way and with more room. And this monetary easing actually will be important to reduce that risk of inflation. Stronger growth is also obviously predicated on the availability of credit. Now the threat here is that if banks move into reverse gear and therefore reduce the amount of credit available, that will be a threat on growth. So solutions should focus on raising capital levels, rather than contracting and cutting back on lending. Maintaining proper and orderly funding and financing is necessary for that growth to actually pick up. Turning to the fiscal policy, resorting to across the board, across the continent, without differentiation, budgetary cuts will only add to recessionary pressures. So we have to be careful of those, generalized principles. Yet, of course, several countries have no choice, but to tighten finances sharply, quickly, without compromising. But this is not true everywhere in the zone. There is a large core where fiscal adjustment can be more gradual, where countries can let automatic stabilizers actually operate. That is, lower fiscal revenue when growth abates and higher spending to remedy that situation. And those with fiscal space, not many, should support the common effort by reconsidering the pace of adjustment that is planned for this year. So, monetary policies, financing the economy, fiscal principles that are applied carefully, tailor-made, depending on the situation of the country. And finally, of course, competitiveness. Now, some people will argue and say competitiveness, it only gives medium to long-term results. Fine. So be it. Number one, there are competitiveness measures that can actually deliver in the short term. But even if it was only in the medium and long term, that is absolutely needed. Because as experience tells us, fiscal sustainability depends ultimately on generating long-term growth. So long-term growth is predicated on those long-term measures that are based on improving the competitiveness. That's for the stronger growth that I referred to earlier. Now let's turn now to the firewall. I know there's a lot of debate about it. We feel that a stronger firewall is needed. Why? Because without it, countries like Italy and Spain, for instance, that are fundamentally able to repay their debt, could potentially be forced into a solvency crisis by abnormal financing cost. And this would have disastrous implications for systemic stability. So adding, I know this is controversial, but adding substantial real resources to what is currently available by folding what's in the EFSF into the ESM, increasing the overall size of the ESM. I didn't say doubling it, increasing the size. And identifying a clear and credible timetable for making it operational would help greatly. Now, indeed, action by the ECB to provide the necessary liquidity support to stabilize bank funding and sovereign debt market would also be essential. But you see, all these measures have also to come together. We must also break what I call the vicious cycle of banks hurting sovereigns and sovereigns hurting banks. This works both ways. Making banks stronger, including by restoring adequate capital levels, stops banks from hurting sovereigns through higher debt and through contingent liabilities. Because at the end of the day, the sovereigns, in many instances, have to guarantee. And restoring confidence in sovereign debt helps banks, which are very important holders of such debts, and typically benefit from explicit or implicit guarantee by the sovereign. So that's for the higher and stronger firewall. Now let's move to deeper integration. And again, let me stress, all these measures go together. One will not come without the others, and if it was the case, we would be back to the piecemeal job that is not especially helpful. Deeper integration. In a sense, the crisis is a crisis of incomplete integration. At the euro area level, if you look at the numbers, it looks good. It does. The current account is balanced, pretty much so. Inflation and fiscal deficits are both quite low. But what the euro area does not handle very well is the imbalances within the zone. In addition, a single financial market cannot rely, especially in times of crisis, on the legal and institutional frameworks that operate on an asymmetric national basis. So, what's needed? Well, to break the feedback loop between sovereigns and banks, we need more risk sharing across borders in the banking system. It needs to be more together and segregated from the sovereigns to the maximum possible extent. In the near term, a pan-euro area facility that has the capacity to take direct stakes in banks will help